This week, the Reserve Bank's Monetary Policy Board cut the cash rate target by 0.25 percentage point to 3.85%. Inflation is now inside the RBA's 2 to 3% target on most measures, and on some of them, it's actually around the midpoint of that target range. Now, this is exactly what the RBA was trying to achieve. And so while it didn't exactly do a victory lap or put out a mission accomplished sign, the governor acknowledged in the media conference that it's now no longer appropriate to have policy as restrictive as it has been. And in that sense, the domestic inflation story justified the rate cut on its own. Accompanying this week's decision, we saw an update to the RBA's forecasts. There was a small reduction in their outlook for trimmed mean inflation from 2.7% to 2.6%. Now, that doesn't sound like a big adjustment, but it was enough to give the RBA more confidence that inflation is in fact going to remain around that midpoint of the 2 to 3 target range. And so in that announcement of the cash rate cut, we saw a considerable change in the rhetoric and the tone about the inflation risks that we have in Australia. One of the other changes to the forecast was a slight upgrade to their unemployment forecasts. Again, this was only a 0.1, but we saw a greater acknowledgement from the Reserve Bank that it is possible that their current forecasts have too hawkish a view of the labour market. The labour market has been remarkably resilient, but it's possible, and the RBA is now allowing for that possibility, that they think that full employment is a lower level of employment and a higher rate of unemployment than it actually is. So again, this is adding to their comfort level about inflation. A third and much larger and very crucial adjustment to their forecasts was on consumption. In their February round of forecasts, their consumption forecasts had been way over what most market economists had been predicting. Our own forecast for consumption growth over 2025 was 1.5% and still is. The RBA in February had been forecasting 2.6%. That's now been brought down to a much more realistic 1.9%. While everybody is expecting a pickup in consumption growth over this year, now that households are enjoying lower inflation and the fruits of last year's tax cuts, the pickup in consumption has actually been weaker than a lot of people were expecting. And again, the RBA is acknowledging that reality in the forecast adjustment. Now, of course, the domestic story isn't all that's going on at the moment. And there was a lot of discussion both in the written statement and the governor's media conference about the trade war and the hit to global growth that implies. Of course, this is mostly a hit to US growth because it is an act of economic self-harm for the United States. Australia is a much smaller target, and growth forecasts have only been scaled back by a little as a consequence. Like Westpac Economics, the Reserve Bank is working on the assumption that the Chinese authorities managed to stimulate their economy and more or less meet their growth target for this year. And that means that the hit to the Australian economy will be smaller than it might otherwise be. The Reserve Bank also recognises that this is mostly a disinflationary shock for the rest of the world. Higher tariffs are an inflationary shock for the US, but whereas in February and April they were saying that tariffs, the effect of the tariffs could go either way, they're now acknowledging that in most possible future states of the world, this is going to be disinflationary for Australia. And this adds to the Reserve Bank's comfort that inflation will remain now in the 2 to 3% target range, and therefore that it may even be appropriate to keep cutting interest rates. So what does the future hold? Well, Westpac Economics still expects further rate cuts this year, at least 2 more by the end of the year, taking the cash rate to 3.35%. It's possible that if the hit to global growth is greater than everyone is currently expecting, then the RBA may have to do even more than what we currently expect. At this stage, it's only a risk case, not our base case, but we will certainly be watching the data and, of course, the policy announcements coming out of the US and elsewhere to assess how things keep moving going forward.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published or reproduced in whole or in part without the prior written permission of Westpac.